No matter where you are on this financial journey of investing, whether you're just getting started or you're nearing retirement, the number one rule of thumb is to just keep at your process, especially if you're a dividend investor. At the end of the day, the more you actually invest today, the more you're going to get back in returns in terms of dividend income, which is, of course, what we are all after. So with that in mind, I thought today I would go ahead and speak to the masses of dividend investors out there, making the case for 3 dividend growth stocks along with 3 higher yielding dividend stocks for those of you who are in need of more income right now today. But first, I want to go ahead and update you on some of our macros because as of the latest US consumer spending report, we just saw a solid increase in October. Now, this is actually really good news for all of us, suggesting that the economy is maintaining its strong pace of growth. But on the other hand, we just had reports coming out that show inflation progress is actually stalling. And as far as I can see it looks like with Trump's tariff plans, the masses of investors are getting quite nervous about the cost of goods spiking and how we're all going to fare under Trump's policies, which are of course expected to be in sharp opposition to Biden's over the last 4 years. Now, until we really understand all of Trump's policies, I think we're going to continue to just experience some ebbing and flowing, or nerves rather, from investors, because at the end of the day, as I always say, investors enjoy certainty. But with that said, your certainty really shouldn't come from economics, but rather the very businesses that you are investing into. So all of the companies that I'm going to run through today will actually provide you with plenty of confidence to have plenty of certainty, just as their balance sheets are clean, the revenues are running high, and of course, they're strong brand names with great leadership teams. So with that, let's kick it off with Polaris, ticker symbol PII, which is in the business of engineering and manufacturing power sports vehicles, as in off-roading vehicles, whether that's for the military, commercial, or even private usage. Now, I would say it's a very interesting pick for me at this point in time, and honestly, the first I'm even mentioning it here on the channel. But I am sharing this opportunity because it really deals in leisure products. And as we just saw, consumer spending is in fact beginning to ignite, and I would only imagine that the feel-good feeling to spend over the next 4 years may very well hit, and that will really help out this particular stock opportunity. So with that said, let's pop open the stock chart here. Polaris is actually down by over 27% and no better there on the 5-year view, all things considered, when it comes to how consumers have been consuming in our economic environment over the last handful of years. Really hasn't been the best environment for them. However, scroll down and you will see a healthy inflow of revenue. Matter of fact, an increase by over 4% just this past year, and a balance sheet that depicts assets well above liabilities by $1 billion plus. Of course, I wish it were a bit cleaner, but nice to see here that total assets are up by 5.7%. Now, in terms of the Polaris dividend, it will come in with a bit higher of a yield here. Clicking into Simply Safe Dividends, we're going to get a safety score of a 70, and that yield upwards at 3.86%. Scroll down, a bit higher of a payout ratio, which is something to be aware of and a bit of a red flag at 61%, but a solid track record here of 28 years worth of paying dividends. And on top of that, an 11% growth rate year over year for the past 20 years. But if you're looking for more of a growth opportunity in your dividend investments, well, you can certainly look into microchip technology, ticker symbol MCHP, which, as you can guess from the name itself, is within the semiconductor or chip space. But the reason I actually favor this type of investment is because chips do everything for us these days, and moving into the future, that's likely to hold true, powering electric vehicles, factory automation systems, to enabling smart home devices, medical equipment, so on and so forth. Now, microchip technology has not had the best or easiest of years. We could see it's actually deep in the red by over 22%. But clicking into the 5-year chart, we can see that the power of investing into this particular opportunity is there. It's up by over 41%. Now, scrolling down, we do see that revenue continues to pour in, but as reported, it has been on a bit of a decline recently. However, their balance sheet does depict a stronger health here, coming in at $15 billion worth of assets to just under $10 billion in liabilities. Now, perhaps you wouldn't take a chip player seriously in terms of its dividend, but microchip has delivered through, coming in with a lower safety score of a 60 overall, but for right now, a 2.72% dividend yield, a 68% payout ratio, and a 21-year dividend streak, streak. But now check this out. We have an average growth rate for that dividend coming in at 18% year over year, at least over the last 20-year period. And if you're an older investor, really in need of some more income now on a monthly basis, I want you to look into Realty Income. This is, in fact, the safest monthly paying dividend stock on the market according to Simply Safe Dividends. And it is, in fact, the kingpin for net lease solutions, making this real estate investment trust personally the only REIT that I would actually invest into. Now, its real estate portfolio consists of over 15,000 properties that are leased out to over 1,000 clients, both in and outside of the United States, keeping this real estate gem very reliable. And right now, while it's not down in the red, we're up overall in the year nominally, it is down from the mid $65 range at just $58 per share right now, which has a lot to do with the Federal Reserve coming out and sharing that they're not going to be cutting rates further at this point in time. Now, clicking to the 5-year chart, you're going to notice that it never really recovered from the pre-COVID levels given our economic environment, yet interest rates, when they were lower, well, this stock was soaring higher and higher. Scrolling down, note the income statement here with revenue up over 22%, and scroll down for a very clean balance sheet with over $57 billion in assets, just $24 billion in liabilities. And of course, this gem, a real estate investment trust, coming in with stellar dividend metrics. As we click into Simply Safe Dividends, we're going to get a safety score of an 80, a dividend yield coming in at a whopping 5.39%, and scrolling down, we get a 75% payout ratio along with a 55-year dividend streak with nominal yet steady growth here in terms of that growth rate, 5% year over year. There you have 3 out of the 6 dividend stocks that I wanted to share with you today. But before I get to the next 3 dividend stocks to draw your attention to, I actually want to take you into my YouTube analytics, where we're going to see that 61% of you are watching my videos, but not actually subscribed. Now, the odd part is you continue to tune in video to video. So if that's you, I want to go ahead and ask you to directly help me out right now and tapping that subscribe button to join the journey officially. And moreover, if you are taking value away from this very video, let me know by tapping on that thumbs up button. That just lets me know that these are the videos that you want more of. With that, I want to kick back into gear with Stephen Company, which deals directly in manufacturing of specialty chemicals. Now, personally, a lot of chemical companies get overlooked, which is very interesting to note because without chemical companies like this one, we really wouldn't have the smooth sailing, functioning world that we have today, as Stephen Company is heavily involved, well, directly involved really in detergent, shampoo, toothpaste, and cosmetics manufacturing, which means they are impacted to an extent by consumer trends. Therefore, we see the company right now down on the year by over 18%, which is only a tad better than the 5-year chart here, which depicts that the stock is down overall by 21%. But what I would imagine is a necessity for an era of consumers getting back to spending more freely to ultimately help the bottom line here. So in terms of the income statement, while we are seeing that it's not the healthiest it can be down, we do get nonetheless a balance sheet which is depicting health with assets that outweigh liabilities, though not by a massive margin. Yet despite all the financials, Simply Safe still rates this company at an 80 of a safety score, a 2.01% dividend yield, and we can scroll down here to get a 62% payout ratio, along with a 57-year dividend streak and a solid 7% average dividend growth rate to enjoy. Now, another interesting opportunity right now that's in the utility space, which could gift you with plenty of reliability, is SJW Group, ticker symbol SJW, which is a water utility processing company that serves just over 1 million customers in California, another 60,000 or so there in Texas. All things considered, with more of a focus on tech and growth opportunities for the massive investors, this stock is currently down by 14+% on the year, and on the 5-year, it's not going to look too much better here, down by 21%. Yet scrolling down, we see very healthy metrics with a revenue increase of 8% and over 15% worth of an increase on net income, while we also see over 15% worth of an increase on total assets, bringing them to $4.3 billion in assets to just $3.11 billion in liabilities. But now with any utility company, what you're really going to get is that reliability and consistency in terms of a dividend. So clicking into Simply Safe Dividends, we're going to get a safety score of a 99, the safest you can get, a dividend yield coming in at 2.86%, then a much lower payout ratio here for utility companies at just 57%, along with a dividend streak for the last 56 years, while steadily growing that dividend by an average of 6% year over year. And if none of those stock opportunities actually do it for you, we can find a greener opportunity here with Next NextEra Energy, ticker symbol NEE, which over the years has quickly become the world's, yes, the world's largest electric utility company, meaning it will likely continue to be a big player moving well into a greener, more energy efficient future. And to showcase its success, we can now click into the stock chart to see that NextEra Energy is trading for just under $80 per share, which is ultimately up by over 28% just on this year alone. Now clicking into that 5-year chart, we're only going to see more greenery here with the stock up by over 35% worth of appreciation. We're going to scroll down here to discover some serious revenue flows with an increase in net income by over 76% this past year. Now scrolling down to that balance sheet, arguably the cleanest on today's list, we're going to get assets coming in around $177 billion, whereas liabilities are just coming in around $118 billion. But now it only gets better from here, because if you're a dividend investor, NextEra Energy is going to deliver through on a 90 safety score on Simply Safe Dividends, a solid 2.6% dividend yield, while delivering through on a 59% payout ratio and a 28-year dividend streak, along with a rock solid 10% growth rate, which is the bare minimum growth rate I personally aim for. But investors, there you have them, all 6 dividend stock opportunities. Let me know your thoughts on each of them, or if you have a better dividend stock list in mind, let us all know down there in the comments. Be sure to tune in right here to join Ryan Williams and I for our latest dividend investing chat. Be sure you're subscribed, and I'll catch you all in the next one.